These should be familiar topics by now. You're a different person today than you were on Monday, and I'm hoping that you can apply some of the things, answer questions, participate mentally and verbally so that we can accomplish what we'd like to. Would you turn in your books with me to exercise 12.3? It's on 583. It's always better when you've got a book in class so that you can follow along. Perhaps the nice person on your left or right would share with you. You'll learn more if you know what the problem is that we're trying to solve. 12.3, the exercise on 583 says, Rose Tyler, forever to be called T, has owned and operated a proprietorship for several years. On January 1st, she decides to quit this old business and become a partner in a new business of T&S. Her investment in the partnership consists of $12,000 in cash and the following assets of the proprietorship: her old business, accounts receivable, allowance for doubtful accounts, equipment, accumulated depreciation. It's agreed the allowance for doubtful accounts should be $3,000 for the partnership. The fair value of the equipment is $13,500. Journalize her admission to the firm of T&S. You had a homework problem for first discussion like this. We talked about it in Monday's lecture. How do you start a partnership? You could contribute cash, or you could contribute assets other than cash. We're doing just one entry. Would you help me? What entry should we make? Lots of volunteers, lots of debits, lots of credits. If you're willing to start me out, let's go for it. Owen.
Go to cash.
Somebody had to say it, Owen. She contributed some cash to the partnership. How much?
$12,000.
$12,000 of cash was received by the partnership from this new partner. I need a new volunteer. Let's go faster. Logan.
Accounts receivable, $14,000.
Accounts receivable, some number. How much, Logan?
Well, it's $14,000, but there's also allowance for doubtful accounts.
So should we record it at 12?
No,
You know, these are real life solutions to problems in this book. I think you see it sometimes as just a bunch of theory and a bunch of rules for somebody else to follow, somebody else made up. I often contend that if there were no accounting textbook, if there were no preconceived answers, if we just sat around a table and tried to solve a problem, we'd come up with a solution similar to this one. So here's a list of accounts receivable, or a file full of them. And we're thinking about investing that in a partnership, and somebody else is about to take this on as a combined asset. Don't you think they ought to go through them and eliminate the bad ones? Which might be a time-consuming process, or difficult or impossible to accomplish. So maybe the new partner says, okay, in the interest of time, we'll take them all with a string attached. What else goes with this $14,000 debit to accounts receivable? We're going to provide for, Brooke, you want to talk to me?
Allowance for doubtful accounts.
We're going to provide for some of these to be uncollectible. Now, she was doing that in her old business. She already had doubt about some of these. How much doubt did she have?
$2,000.
$2,000 worth. Y'all with me here? She doubted 2,000 of those. She didn't know which particular ones. If she had known some of them had been bad for sure, surely she would have thrown them out already. But as she allowed this to be subject to somebody else looking at it, her new partner, apparently the doubt increased. You finish this thought. Please, a new volunteer. I'm looking for debits and credits. Talk to me, Justin.
$3,000.
Where?
It says it is agreed that the allowance for doubtful accounts should be $3,000 for the partnership.
I don't know where this goes for sure, but I'm taking a risk right this second that it's that one. Oh, yes. Phew. How much, Dustin?
$3,000.
They agreed on it. Anybody remember me saying in Monday's lecture, you can't say agreed too many times to me this week? That's what partners do. They looked at this, they analyzed it, they thought about it, they agreed on it. I thought debits and credits had default. They don't. Let's go for it. I need some help. Justin,
Debit equipment.
you up again?
Yeah.
Can I do 2 in a row? Same person?
You can if you want to.
I don't normally though. Oh, Justin, I'm desperate here. Let's go for it.
Debit equipment
How much?
for $20,000.
I'm thinking multiple choice. I'm thinking 20,000 is a good answer, Justin.
Oh, $13,000.
Oh, I think 13.5 is a good answer, Justin. Oh, I can see another good answer here. If I can get my eyes straight. Oh, how about 16,000? Anybody see 16,000 in the book? You see it, Sam?
I don't see it.
I want you to see it.
Oh,
Do you see 16,000 in the book? Yes or no, class?
Yes.
Y'all want to suggest any other multiple choices here? Okay, line up. Logan, which is it?
It's the fair value, 13,000.
13.5. Justin, which is it?
13.5.
Tell me one word to describe the manner in which we record assets. Everybody that knows it said. Ooh, you're killing me. It's 4 letters. A consistent theme that runs throughout the asset section of the balance sheet. I got one hand up. Don't say it yet. I'm trying to get a whole big hearty group answer. I'm going to give you one more time. The consistent thread that runs throughout the asset section of the balance sheet is that we record assets at. Everybody said?
Cost.
I feel like I just went to the dentist and he yanked one. Is anybody with me right now? But we've got an old business that paid $20,000 for this a long time ago, which really has absolutely nothing to do with this new business that's taking that same piece of equipment or that equipment, plural, lots of those items, and recording it at cost. The problem is they're not going out and writing a check for it. There will be no invoice. Then at what price should we record them? Logan?
The fair value.
That's not the word I wanted to hear. It's straight out of the book. It's right. It's true. It's accurate. Yes. Logan, what am I trying to hear from you?
Can you repeat the question?
No. I probably could. I don't know if I could or not. David?
Agreed. Value.
Didn't I just say you couldn't say agreed enough to me? Oh, okay. What's happening is that they're going to agree on something. Now, the question is, what are they going to agree upon? There's your cue, Logan. The fair value. What if they didn't have this piece of equipment? What if they didn't want a new one? They didn't want to pay full price. What if they went to the used furniture store and found one that would be adequate? They might have to pay $13.5. Or what if they have this one? It's a little dented and a little scratched, and they don't know what its fair value is, and they just go window shopping at the used furniture store, and they find one that's about in the same condition, and they want $13.5 for that one. So they're saying, this one must be worth $13.5. Are y'all with me or not? We don't know cost, but their agreed valuation is going to become cost. What if, Logan?
Why would they not use the accumulated depreciation?
I haven't even established that yet. Would you give me a chance?
Yeah.
So if allowance for doubtful accounts is connected to accounts receivable, what's connected to equipment? How much accumulated depreciation shall I record on this right this minute? I need a volunteer hand up. Who's going to talk to me right this second? I thought you were asking the questions, not answering the
I have a
questions.
question about it, but I know the answer.
Logan?
None. You don't record the accumulated
Logan,
depreciation.
to whom, what was it, $4,000?
Yes.
To whom does the $4,000 belong?
The old proprietorship.
The old business took the $14,000. Logan, how much depreciation has the new business taken on this asset? That's the point. We're starting over. It's a new asset to the new business.
Well, why wouldn't they record it at $16,000? Couldn't they trust?
Well, because that's not what they agreed on.
Okay. All right.
Good, Logan. You're helping us all. You're asking the questions that everybody else is too timid to ask in here. Are y'all with me right this minute or not? I thought debits and credits had to equal. They don't. Shannon, is that an answer hint? Go.
Credit Tyler Capital at 36,000.
Say the number again.
36,000.
How did you get 36,500? We all want to know. That's what you meant to say? Go ahead. Tell me, Shannon.
The sum in debit column was 39 minus the miles per gallon.
You said that very well. Thank you. There's a name for what you just did, Shannon. Do you know the accounting name for the process you just described to me?
Yes, it's not summing or...
There's a word for it. Who's heard me say this word before? Not enough of you are raising your hand, but you didn't know cost, and cost was a whole lot more important than this one. I have no trust in you. It's your fault, not mine. David, the word I'm trying to get him to say is?
I believe it's forced.
Oh, that's an equivalent word, but that's not the accounting word.
Oh, darn.
It's 4 letters. Say the word.
Plug.
This is a plug. We plugged it. We forced it to balance. Who's heard me say plug before? Well, book value, plug, cost, those, come on. Don't make me teach it over and over, okay? It's a simple process. There's good plugs and bad plugs. Shannon, is this a good plug or a bad plug? I don't know of another way to do this but by plugging it, forcing it to balance. If you've got a question about this entry, you should ask me right now. In your homework, you did another one. You had 2 partners. And the repetition there was good. We've got more fish to fry today than that. We're moving on. But this ought to become more clear to you because of this extra practice that we just invested. Are you doing okay? Yes or no? Would you turn, let me give a little talk before we turn to 2 exercises that we're going to do to describe admitting a partner. It seems to me that there are 2 ways that you can acquire a partnership interest. And I'd like to contrast them with 2 stories, A and B. Now, in story A, there is an existing business owned by an individual who might have founded it or been an owner in it for some time and is tired, would like to work less and play more golf. And one of the young whippersnappers he's been playing golf with is interested in his business. And he sees, the old owner sees the potential in the new guy, and they talk about it every time they play golf. So sure enough, they've reached the point that they're about to strike a deal, and new young whippersnapper is buying some of old tired guy's interest. Y'all with me here? And old tired guy has the obligation to call the business and instruct the person to transfer some or all of his ownership to the new person. And her name must be Ms. Busybody. Was that a sufficient description? Because she was willing to accept his instructions, but had to follow it up with, "What'd you get for it?" To which he responded, "None yet."
What he lived with.
Are you with me or not? Yes or no? For now, yes or no? Contrasted with story B, that involves an existing business that finds themselves in one of 2 possible situations. One of those possibilities is that their location is on the best corner in town. They have high traffic volume. They have fabulous customer service. They have an outstanding product. Their phone is ringing off the wall with people trying to get into their business. They want to buy in. Or they're not doing so well. Their heyday is in the past. They've been on a little decline and they'd like to reverse that decline, and they're looking for new ideas and new energy and new money to carry out those ideas. And along comes willing investor to help them out in whichever situation. I'll have more to say about this in a minute. They decide this is the person they'd like to include in their existing partnership. And that person invests in the partnership, and they get the money and run with it. You did those very things if you did your homework for today. You've seen those situations. See them with me again. Would you turn with me to brief exercise 12.7. It's on page 581. Brief exercise, not exercise, but brief exercise 12.7 says B company's capital balances are A 30, B 25, G 20. The partners share income equally. R is admitted to the firm by purchasing half of G's interest for $13,000. Before you journalize the admission of R to the partnership, would you look at the screen and tell me, was the story I just read to you A or B? You've got 3 seconds to think, and we're going to vote. Was the story I just read to you A or B? Who says A? Who says B? Somebody want to defend your opinion? Somebody tell me why you think it's A, and somebody tell me why you think it's B. I need 2 hands up. Let's go quicker. Joel.
Well, it says that a new partner was admitted instead of buying part of the
Which are you proposing, A or B?
B.
B. A new partner was admitted? Yes? You think it's B? Owen, which would you like to represent? Tell me about A, Owen.
Well, a new partner was admitted, but is admitted by purchasing part of the old partner's interest. So he purchased part of Gump's and Gumpus's or G's
Thank you.
interest.
That's why we say G. Wants to figure all that out.
But he purchased half of G's interest, so he would have paid G for half of it.
These were 2 good arguments. Were you swayed? Did you change your mind thinking a little longer? Let's vote. Everybody votes. A, B, it's A. And if you still don't see it, you'll see it in a second, okay? But one of the things I need you to see from the picture is who gets the cash. The old partner got the cash, the partnership didn't. The partnership got the cash. That's the big contrast that we're drawing here. You're capable of helping me make this entry. Let's do it. Journalize the admission of R to the partnership. Who'd like to try this for me? Owen.
Debit G capital and credit R capital.
Debit G capital and credit R capital, translated to say debit old partner's capital account, credit new partner's capital account. Is that an adequate translation?
Yes.
The balance of capital is credit. The old partner, G, is giving up some or all of his share in favor of the new partner. How much, Owen?
700.
I didn't hear you, I'm sorry. Owen?
I'm sorry, 10,000.
13,000.
No. That's how much he paid for it. But that's not how he paid 13,000 for half of his 20,000 ownership in the company, which would be 10,000.
Joe?
Would it be 6,500?
That's a question.
Okay, then 6,500.
Half of 13,000.
Yes.
You're thinking multiple choice with me. Thank you. Anybody you want to suggest a multiple choice possibility? The old partner had a $20,000 capital account balance. R bought half of this person's interest. We called the business and said, transfer $10,000 of my ownership. Transfer half of my ownership to the new guy. And by the way, the other partners would have to agree on this. It's assumed that they did, okay? Remember Nanya? Remember that part? That was the hint, the big strong hint that 13,000 doesn't matter in this problem. You remember that part of the story? The 13,000 is there to kind of trick you or to get you to understand it better. The money didn't go to the partnership. The money, the 13,000, went from the new partner to the old partner. Is this individual who got that? I'm having a flashback right now to first semester, first class, really first vocabulary term, business entity concept. This whole course, this whole theory is built on business entity concept, that the owner and the business are separate. Let me show you differently. That the owner and the business are separate. And that's really punctuated with ... Finish that thought. Anybody know the rest of that thought? The owner and the business are separate, and we're accounting for whom?
Business.
We're accounting for the business. Consistently throughout this book, consistently throughout this concept called accounting, we're accounting for the business. But don't you think somebody has to account for the owner? Yes or no? The owner needs accounting too. The end of this lesson, we have reached the end of this lesson. This lesson ends with this entry. That's it. May I give you a little bonus here, and could we have just another sentence or two to ice this cake while we're right here? Let's look at this from the owner's perspective. We weren't asked to do that. I'm stretching you beyond expectations. This owner had $20,000 that he'd invested, and he sold, it's not dollars right this minute, it's an investment in a partnership. He sold half that interest for how much? Say the number.
13,000.
And gained or lost? Would that have any consequence to him personally?
Yes.
Would he have to pay tax on that? Yes. Have you heard the word realization this week? Realization occurred. He changed the nature of that investment from an investment in a partnership to cash. And measurement occurred. And he'd have to report that. He's got a personal accounting issue. That's where the 13,000 is involved. I'm about to move on. If you've got a question about anything that just happened, you should ask me now. Logan?
When you say interest, are you talking about equity in the company?
Uh-huh.
Okay.
Anybody else? Let's do another. Let's read 12:8, the brief exercise. At the conclusion, I'm going to ask you if this sounds more like story A or story B. I hope you'll be making up your mind. In C Company, capital balances are G, 40, and N, 50. The partners share income equally. S is admitted to the firm with a 45% interest by an investment of cash of $52,000. Journalize the admission of S. Story A or story B? Let's vote. Story A? Story B? Way to go. Good job. Let's make an entry. In fact, I think this one ties to the story I began a little bit ago. Do you remember two situations we could find ourselves in? The great location, the great product, the great customer service, everybody wanted to become part of this, or we've reached our heyday already and we've been declining and we need some investment of ideas and capital? That story continues with, there are three possible outcomes with a person investing in a partnership in this fashion. Story B. If this person invested this amount of cash in a new partnership, they might get a capital account balance exactly equal to that. Or, if this person invested that much cash, they might get a capital account greater than or less than the amount they invested. If this business is struggling, then this bonus, this extra amount, might be an incentive to get this person to come into the partnership. We really want this person. Great ideas, lots of energy, and some money to implement that. The old partners might be willing to take some of their capital and give it to the new partner, to give the new partner a capital account greater than the amount of their investment. That situation is called bonus to the new partner. Or maybe everybody's calling, the phone's ringing off the wall. We've identified one particular person that we're going to allow to invest in our company. This great location and great reputation and willingness for somebody to pay extra to get into the business because they sense the earnings potential that's there would be credit to the people who've worked hard to establish that. That'd be bonus to the old partners for the good job that they've done. Now, we're not going to do both of those situations, but it's easy to envision, after we work this solution in a second, that we could come up with that possibility. I need your help. Tell me the obvious parts of this journal entry. A new person invested in the business. A new volunteer responded. Jason?
Debit cash, 52,000.
Good. This time, the partnership really got it. That's the difference between stories A and stories B. That didn't happen last time. I need a new volunteer. What else happened when cash of $52,000 came in? May I help you right this minute? Megan, I need your help. Would you look in your book and would you tell me the balances of the capital accounts of the existing partners right this minute? Help me out here. 40,000 was one partner. 50,000 was another partner. Class, are you with me? Say yes or no.
Yes.
You see those facts in the book? And then this new partner invested 52,000. Is that the number? 52,000 additional cash invested. Help me with the math. This is 142,000. Yes or no?
Yes.
Total capital after the new partner invested is 142,000. And this partner gets what percentage of ownership? 45% of that belongs to the new partner. Help me with the math. 142,000 times 45% is
62,900.
62.5? 63.9. Thank you, Nathan. 63.9. Was that you with the U on your chest last night?
That was.
And you won the
I won.
toss thing?
Yep.
Congratulations. 63.9 is this person's capital account. Do you realize what we just did? I was trying to fish it out of you. Let me state the obvious here. That's a credit to the new partner's capital account, S capital, for 63.9. That's what we just determined. Are you with me right this minute? Say yes or no.
Yes.
I thought debits and credits had to equal. They don't. There were two possible situations. If he was not going to get an amount equal to, he's going to get an amount greater than his capital balance because they wanted him so badly. Then at what proportion do the other partners fork over some of their investment to accomplish this? I'll help you with this. So let's take the 63.9 and compare it with his investment of 52 to see how much excess we're dealing with. Help me with the math. This difference is
11,900.
11,900 needs to come from the old partners to the new partner in their profit loss sharing ratio. If it was 5 to 3 to 2 or 2 to 1 or whatever it is, it says in the problem, I recall,
Shared equally.
Yes or no?
Yeah.
So 11.9 divided by 2 is
59.50.
59.50 has been suggested. I need an auditor.
That's correct.
Ooh. 59.50, I need an auditor.
Yes.
I've got a debit to cash, I've got a credit to capital that are unequal. Who's willing to finish this off for me? You've answered every other question about this. Should I allow you to do this, Nate? Yeah, come on, Nate.
Alright, you debit G capital for 5920 and debit N capital 5920.
The 5950 we got over there. Why are you debiting capital?
Because they're having to give that to the new
Is
partner.
debiting capital increasing capital or decreasing capital?
Decreasing, they're having to give it up.
That's exactly right. They're taking their share and giving it to the new partner to entice the new partner to come into the business to help them out. If you're with me right this minute, say yes.
Yes.
If you've got a question right this minute, I'd try to entertain it. Let's do 12.4, the exercise. 12.4, the exercise, is in the middle of page 583. And says, M and J have capital balances on January 1st of $50,000 and $40,000 respectively. The partnership income sharing agreement provides for salaries 20 and 12, interest at 10% on their beginning capital balances, and the remainder shared 60-40. In Monday's lecture, we talked about the partnership agreement attempting to reward partners for their unique contributions, their gifts, talents, if you want to think of it in that terms. What they're providing to the partnership to help the partnership be successful. And we can come up with some pretty creative ways to do that. Typically, one person puts in more money than the other. That's the object of calling part of it interest. It's not interest. These are not creditors. It's a way to split up the net income. Typically, one partner puts in more time than the other. So we allocate part of net income and call it salaries, even though it's not. They're not employees, they're owners. And other unique ways to accomplish that distribution of net income to the partners. The instructions say, prepare a schedule showing the distribution of net income, assuming net income is 50 and assuming net income is 36. I did one illustration like this in Monday's lecture, which would be, in this case, the equivalent of $50,000 of net income. I didn't get to the second illustration. I'm encouraging you again, I did on Monday, and encouraging you again, to watch just that last little bit of the lecture. There may be some topic there that we didn't quite get to, but it's there on the video. You could see just that part, a few minutes, and re-emphasize this point and increase your confidence and understanding about it. We're going to use what the book calls this schedule. It's just an analysis. It's just some columns and rows to try to help us think through this. Now, you could do it in your head. You could do it on a calculator, but my contention is that when you're deliberate like this, you make less mistakes, and when you make mistakes, you're more likely to see them and be able to correct them if you use a format like this. We need a column for every partner. In this case, 2. But it could just as easily be 20 or 200. We need a total column. Don't forget the total column. And we need a row for every part of the agreement and a row for the remainder. The next thing I would do is talk about the total amount of net income. I'm skipping the first part of this. You've seen the equivalent. I'm working the one that's different from lecture. We're assuming the second part of this, $36,000 in net income. I've got partners of M and J. Their agreement provided for them to get some salaries and them to get some interest. I've already addressed that. The reason I put them in quotes is because they're misnomers, not very good words, not used in the context that we're accustomed to seeing them. It's a different use. We also have to deal with the remainder. Help me with the facts. If you can say the 2 salary amounts to me, would you raise your hand so that I'd know to listen to you? Their salaries, Justin, were
20,000 and 12,000.
20 for the first partner, 12 for the second partner. Sums to how much, Justin?
32.
32,000 of net income was distributed in that one step alone. If you're willing to do the interest calculations and say the resulting numbers for me, would you raise your hand so I know to listen to you? Brooke?
5,000 for the first partner.
10% of 50,000 is 5,000, Brooke.
4,000 for the second.
10% of 40,000 is 4,000. In that step alone, Brooke, we allocated
9,000.
Do you see the problem we have, class? Say yes or no out loud.
Yes.
We have $36,000 in net income, but in this step we allocated $41,000. Are you with me?
Yes.
In Monday's lecture and in your homework, you had a positive number here. You found that number by subtracting what we allocated already from the total. It's the same process with a slightly different outcome. The difference between this amount allocated and the amount we had to allocate is, everybody said? $5,000 positive or $5,000 negative? Give me a name for that number. Give me a name for that number. I'm trying to trick somebody into saying net loss. Did you hear the part about trick? I'm trying to trick somebody into saying net loss. Were you thinking it? It's not a net loss. This is net income. It clearly states that. It's a negative remainder. Our agreement forced us to allocate more than we had to allocate. And we've got to solve the problem. This is the solution to the problem. A negative remainder that was to be shared how? 60-40. 60% of 5,000 is 3,000 negative. Yesterday I was doing this and a student raised his hand and said, does parenthesis mean negative? Yes. And 40% of 5,000 is 2,000. Let's sum. 20 plus 5 minus 3 is mumblers. And 12 plus 4 minus 2 is
14.
Who can describe for me what we should do right this minute? Would you explain what you meant?
You would add 22,000, 14,000 should equal 36,000.
Never pass up a chance to check your own work. Is 22 plus 14 equal to 36, class?
Yes.
Now, this is where we got in Monday's lecture. And the important part of this is the very next thing. Do you have any idea why we did this other than it's just one more hurdle between you and walking off across the stage at graduation? Did we just do this for purely academic sake? Or is there some reason in business that people would do this? Ever heard of closing entries? Am I going to get any response out of you today?
Yeah.
Ever heard of closing entries?
Yes.
How many steps are there in closing entries? What do you close in the first step? Come on, talk to me. What do you close in the first step?
Oh, no.
Just say one word.
Revenue.
Second step? Third step? Fourth step?
Drawing.
Revenue, expense, income summary, and drawing. Let's talk about the third step. In the third step, when you close income summary, you close it to
Capital.
capital. First semester, how many capital accounts were there? One. We were a business owned by one person. Now we're a business owned by more than one person. The whole purpose of this schedule was to accomplish the third step in closing entries. Who will make it for me? Asher.
Debit Martha Capital 22,000, and then debit Jones Capital 14,000, and credit income summary for 36,000.
Debiting capital will increase capital or decrease capital?
Decrease.
What does net income do to capital?
Increase.
Do you like your entry?
I think so. I guess I'm tired.
No excuses. You volunteered. You can do this.
I like it, but
I don't like it.
okay.
But I like you volunteering. And I like you giving me a wrong answer that we can learn from. What does net income do to capital?
That increase.
Make me an entry that will increase capital by these amounts, please.
Okay. Oh, we're not closing, or are we closing?
We're closing income summary to capital.
So debit income summary 36,000.
And credit?
Martha Capital 22, and Jones 14.
Are you with me right this minute?
Yep.
Is it okay to make a mistake in here? Way to go. Who's with Asher and me right this minute? Hands up. Good. Do you understand why we do this? Yes or no?
Yes.
For this. If I had time, I would work question 16 with you right this minute. We'll probably work it at a review session someday. Have a nice day and a nice weekend.